To the people in Japan, as the Prime Minister, today I have decided to dissolve the House of Representatives on 23rd January. After dissolving the House of Representatives on 23rd January, the campaigning will start on 27th January, followed by the general election, which will be held on February 8th. I plan to hold the election immediately as such. I, myself, am staking my career as Prime Minister.
The Japanese Prime Minister Sanae Takaichi announcing plans to hold a snap election next month. The tax cut story is really kind of what is enlivening markets, though, this morning. She wants to cut taxes aggressively. I feel like I've seen this movie before. We're seeing a big sell-off in Japanese bonds as a result of this. Is the BOJ going to have to react? Do I need a lettuce? These are the key questions that I think I'm asking myself this morning. Let's try and find out what Jordan Rochester thinks about all of this. Head of FICC strategy at Mizuho EMEA. Good morning.
Good morning.
Do I need a lettuce?
No, you don't need a lettuce. In fact, she's extremely popular.
Yep.
That's kind of why the market's reacting the way it is. She's got some of the highest approval ratings. This is going back to Abenomics. So the market's pricing in a potential majority and a potential strong majority, giving Takaichi to go back to the policy positions that she had a year ago before she softened her views on fiscal spending and monetary policy. That's what got her into the leadership, becoming a bit more sort of balanced with the rest of her party. But the market's fearing the idea of fiscal spending, but also leaning on the Bank of Japan to not raise interest rates.
Is the Bank of Japan going to hear but not listen? Is the Bank of Japan going to do what she hopes? Is the Bank of Japan going to be forced to raise rates? We're starting to see a little bit of a repricing here. The Bank of
Japan's independent, but the market is aware that politics does play a factor into their decisions in terms of timing around elections. So that was the main concern for timing the BOJ. Now what the market's doing is it's saying that the Bank of Japan could raise rates twice or three times this year. That's kind of where commentary is going. I saw some notes from Citi, for example, pushing that way. Is April a live meeting? For us, it's possible, but it's now a little bit over-egged. I think that it's still the case that the BOJ will want to raise rates every 6 months because they follow the data. Now, whilst the fiscal is a stimulative sort of move, she's cutting taxes. And what that will actually mean is that inflation will mechanically come down quite sharply. A consumption tax cut on food takes off around 1.5% from Japanese inflation. She's also got government gasoline taxes that they scrapped in the budget that they're trying to get through as well. We could see CPI in Japan in single digits. Most central banks wouldn't be doing a rate hike when that's the case, but they will try to look through that because that is government-forced moves in the CPI. They will try and look at underlying inflation. The labour market is very tight in Japan, which keeps us on course for saying we should have a sort of every 6 months a rate hike. But the other factor is dollar-yen. Right now, dollar-yen has been flirting with the sort of FX intervention levels of 2024, which is between 158 and 162. The Finance Minister Katayama and Mamura-san, the FX Chief of the Ministry of Finance, have both given probably the strongest FX verbal intervention they can. We've got a sort of rankings. It's at the top level before they actually usually intervene.
Okay, and when they intervene, sometimes they do it on days where the US is closed. So we were poised to see, because there's less volume in the market, you don't have to spend quite so much of your pot, I suppose, to support the currency. There wasn't particularly any evidence of that yesterday, was there? So do we still have this expectation then this week, perhaps, that we see intervention from the Ministry of Finance?
It's anyone's call. It's only their decision, really. It's a human decision at the end of the day. It's when we get to sort of 162 in dollar yen, then I'd start to say, hang on, this is now very live as a risk. But the market is currently toying with all of these moves from the BOJ. Is what we're seeing is large selling from domestics in terms of the way the JGB's moved over the past 24 hours, is what I guess is going on. Dollar yen's heading higher. So it's this situation we've seen in the UK before, lower foreign exchange and sort of higher JGB yields. In the UK's case, it was gilts. When it comes to the sort of FX intervention, you usually get massive moves when they come in. So is it really worth being long dollar yen? Because if they do come in, you're going to have a 3 to 5% drawdown the day they do intervene. So for a lot of investors, they're pulling back and staying very light in their dollar yen exposure.
Mindful of the possibility of intervention. Looking at the bond markets then, looking at the 40-year, up by 20 28 basis points, Jordan. Is this the kind of situation where you need some kind of circuit breaker, where you need action, where you need something to happen, somebody to come in and do something? In the UK case, it was the Bank of England, but that was very much to do with some dynamics around the pension industry. Does something need to happen here, or does this just settle down by itself?
Well, let's go through what's going on. The majority of JGBs are held domestically, but what's changed in the past 5 years is that the majority of the volumes traded every day are from foreigners. It's now over 50 to 60%, depending on which part of the curve. So you're seeing much more volatility in JGBs than we've seen in most of our careers. Now, they have stepped in before they've either changed rim ban auction sizes, or the Ministry of Finance has tried to change the size of the issuance in the long end, which is what they've been doing. They have been trying to reduce their 20-year, 30-year and longer and issue more in the 10-year and below. I suspect we'll see more of that.
To be clear, so foreigners own what, 7% or something?
A bit higher. I think it's closer to 11.
11%. And so the volume moves on to some extent. You can strip some of that out because the volume is coming from that 11%. Is that right? I mean, how much we read into the...
So a lot of those JGBs are held by the Bank of Japan themselves.
Yes.
The other part is insurance and pension funds who buy to hold.
Yeah.
So they're not in and out on a daily basis.
Is there a financial risk? I mean, Anna brought up the pension crisis that we almost faced here in the UK because of those commitments to long-term gilts. Is there a similar potential crisis brewing for insurers and banks and the liabilities they have exposed?
I don't think so, because you had the LDI market with all the leverage in the UK, and they were trying their best to get out the door at the same time.
Okay.
That's kind of why you had the crisis in the UK.
What level of yield are you looking for to see that repatriation of funds back to Japan?
It's a big question.
On the 10-year, is it below that?
So we're having loads of foreign interest in JGBs right now, hence the volumes have picked up, because when you FX hedge it, you get close to 6% to 6.5% on the 30-year JGB as a dollar-based investor. That's why.
Quite attractive.
So you're getting record foreign inflows, but you're actually getting net selling by domestics because they're waiting for the uncertainty around the BOJ rate hiking cycle to come to an end. So in answer to your question, the flows will come back from the domestics when things calm down, and things are not calming down.